The missiles hit, the screens froze, and within minutes the entire weekend narrative flipped. A strike on Iran, a fast retaliation cycle, and suddenly gold isn't trading like a metal, it's trading like a heartbeat. And the question in front of you is brutal. When futures reopen, does silver gap higher? Or does it whip first and punish everyone chasing the first candle? You're going to hear a lot of certainty tonight. Clips, hot takes, straight is closing, oil is gone, gold is already at $5,600, silver is about to explode. Most of that certainty is theater. What you need is a framework. What appears to have happened, what markets usually do right after a weekend shock, and the quiet second-order effects that decide whether the move sticks or fades. I'm not here to do politics. I'm not here to treat real suffering like a trading game. People get hurt in wars, families get broken. We can acknowledge that and still talk about market behavior, because ignoring the market won't protect your capital. Here's the headline, clean and direct. Reports describe a major strike on Iranian targets, followed by retaliatory action that reached Israel and multiple locations across the Gulf region. When that sequence hits the tape, the market stops acting like a spreadsheet and starts acting like a nervous system. Reflex, hedge, panic. Then, because it's the weekend, noise. Sunday evening futures is not Monday morning cash. The first hour can be thin. Thin means the same order size moves price farther. Thin means one headline can shove the market like a gust of wind. Thin means you can get a dramatic print that looks like the truth. Until Asia opens, until premiums speak, until real liquidity walks in and rewrites the story. So lock this in. Don't marry the first candle. If you're watching from a different day or time zone, drop your day and date in the comments. It's always wild seeing how the same move feels totally different depending on when you experience it. And a quick clean CTA before we go deeper. If you want more of these fast, no-fluff breakdowns when the world gets loud, subscribe. One click. It helps the channel, and it helps you stay out of rumor loops when volatility hits. Now let's build the map because the internet version of this story is a blender. Real reporting mixed with recycled footage. Real explosions paired with the wrong label. Old clips reposted like they happened 10 minutes ago. People stitching fear plus dramatic B-roll because fear pays. So your first skill tonight is not predicting a price. It's filtering inputs. A rule that saves money. If a clip has no timestamp, no location, and no second source, treat it as unverified. That's skepticism, not cynicism. Skepticism says, prove it before I bet. Cynicism says everything is fake. Cynicism is lazy. Skepticism is profitable. Now, what does the market care about first? Energy and logistics. Because even if you don't trade oil, oil trades you. The Strait of Hormuz is not a trivia fact. It's a choke point. If shipping even hesitates, the oil market reprices risk immediately. And once oil reprices, everything hears it. Freight, air travel, industrial costs, inflation expectations, bond yields, the dollar. Those are the invisible levers that pull gold and silver around like puppets. And here's the part most streams skip. Oil doesn't have to actually stop for metals to react. The possibility is enough. Fear premium can do the damage before a single tanker turns around. Now add insurance. Insurance is the plumbing of global trade. You don't think about it until it stops working. When war risk insurers start talking about cancellations, exclusions, or sharp repricing, that's not drama, that's mechanics. More expensive coverage means higher shipping costs. Higher shipping costs means tighter margins. Tighter margins means supply chains strain. And strained supply chains are where paper prices and real prices start to diverge. That divergence is where the real story lives. Because paper can print anything when liquidity is thin. Physical can't. So if you want a reality check during a headline storm, don't only stare at spot. Watch premiums. Watch delivery windows. Watch inventory notices. Physical tells you what paper tries to hide. Now the weekend trap. Weekend trading is like judging a city by walking through its airport at midnight. Lights are on, people are moving, but it's not the full picture. Big participants aren't all there yet, and the ones who are there are often reacting, not building. So the violent first move can be real information, or it can be a thin hallway where one runner makes everyone sprint. That's why you need a two-step mindset. Step 1. What does price do in the first hour? Step 2. Does it hold when the world wakes up? Now we can talk gold versus silver because they are cousins, not twins. In shocks, gold often behaves like a seatbelt. It tightens, it steadies. It catches the panic bid first because it's the global reserve metal, the collateral metal, the I don't trust tomorrow metal. Silver is different. Silver has that monetary story, but it also has an industrial engine. That gives it a split personality. In the first wave, silver can run because it's high beta to fear. Then it can whip because it also cares about growth expectations. So when you hear, silver will definitely gap higher, translate it as, silver will definitely do something dramatic. Dramatic doesn't always mean up. Sometimes silver spikes, dumps, then spikes again, because silver is not just a metal. It's a psychological test. Now let's address the most viral claim floating around. Gold is already at $5,600. What people are pointing to is tokenized gold prints, venues where tokenized products can trade at a premium during stress. That premium can be real demand. But it can also be venue friction, limited liquidity, limited redemption, market makers pulling bids, spreads widening. Think of it like an airport gate during a storm. The plane didn't become more valuable. The gate became crowded, and the price of getting through the crowd went up. So if someone flashes a giant print and says, "This is the real gold price," ask 3 questions. Where, when, and under what liquidity conditions? And here's your first comment question. Do you think tokenized gold reflects true crisis demand? Or is it mostly a liquidity and venue effect? Drop your take. Now, what actually drives a sustained move after a geopolitical shock? Not the first headline. The second and third wave. Wave 1, shock. Price jumps because nobody wants to be caught unhedged. Wave 2, correction. People realize some claims were exaggerated, some footage was old, some accounts were farming fear. Price retraces, confidence wobbles. Wave 3, reality. Insurance rates, shipping routes, flight cancellations, emergency meetings, energy inventories, policy responses, bond market inflation expectations. Most people trade Wave 1. Pros wait for Wave 3, because Wave 3 tells you whether this is a headline spike or a regime shift. Now yes, you'll see talk about leadership events and this changes everything. If those reports hold, that can change duration and intensity. But in real time, early details can be wrong even when they're loud. So treat the first hours like a draft. Watch confirmations, watch walkbacks, watch what price does after the emotional burst. Now zoom out. There's a background force under this story that doesn't care about this weekend's clips: central banks. For years, they've been accumulating gold because reserves are trust. Reserves are politics. Reserves are, I want something that isn't somebody else's liability. That steady demand changes the floor under gold. Retail panic comes and goes. But big, steady buyers create a different backdrop. Now layer uncertainty on top. You don't need a conspiracy for gold to stay supported. You just need uncertainty, plus buyers who don't care about your Monday chart. Now the silver question. Will silver gap higher at the reopen? It can. But understand what a gap is. Price discovering itself after trading was paused or thin. And here's the trap. The first gap is often an overreaction. The second move is often the truth. So don't build your plan around, I must catch the first print. Build it around, what would have to happen for the move to hold? If the gap holds, you'd expect escalation that looks durable, oil that stays bid, and logistics constraints that persist. If the gap fades, you'd expect headline flow to cool, diplomacy signals to leak, oil to give back fear premium, or, this one matters, a liquidity squeeze that forces funds to sell what they can, not what they want. That last part is why you can see metals dip briefly even in crisis. Not because the thesis died, because margin calls hit and somebody needed cash. So if metals dip after ugly headlines, don't assume the story is over. Sometimes that dip is the forced flush before the longer move. Now, Asia. The reopen happens, price jumps, and everyone declares victory or defeat. Then Asia comes online. If physical demand is tight and premiums run hot, you can get a second surge as the global market tries to close the gap between paper and physical. If premiums are calm, the first move can bleed out. This is why watching physical signals matters more than watching influencer certainty. Now let's get specific, because watch the reopen is useless unless you know what the reopen usually looks like. There are 3 windows, and they can tell 3 different stories. Window 1 is the first hour of the futures reopen. Liquidity is lighter, spreads are wider, and price can jump like it's stepping on broken glass. This is where you see emotional prints, because everyone is reacting to headlines, not building positions. Window 2 is Asia. This is where the market gets a second brain. If physical hubs are paying up, you will feel it. If premiums are calm, you will feel that too. Asia can validate the first move, or expose it. Window 3 is Monday morning, when desks and real volume show up. This is where you find out if the market is repricing risk, or if it was just panicking in the dark. Now, the invisible drivers behind the visible drama. Everyone watches missiles. Professionals watch bonds. Gold doesn't only trade on fear. Gold trades on real rates, the dollar, and inflation expectations. If oil spikes, inflation expectations can spike. If inflation rises faster than nominal yields, real rates can fall. Falling real rates are oxygen for gold. But if yields spike faster, gold can chop even with scary headlines. The headline is the spark. The bond market is the fuel. Silver gets caught in the crossfire. Because silver reacts to gold's monetary bid, and it reacts to the industrial mood, and it reacts to liquidity. That's why silver can agree with gold for 10 minutes, then violently disagree for the next 10. Now, 3 scenarios you need to be ready for at the reopen. Scenario 1, gap up and go. Opens higher, keeps marching, dips get bought. Usually happens when the market believes the risk is durable and the mechanism is real. Energy, logistics, insurance. Scenario 2, gap up, then fade. Opens higher, everyone celebrates, then it bleeds because the first move was fear premium without follow-through. This is where people get trapped twice. Scenario 3, gap down first. Even with scary headlines, markets can open lower if positioning was crowded, if margin calls hit elsewhere, or if early liquidity is one-sided. A gap down doesn't automatically mean the story is over. It can be the flush before the turn. Here's the cliffhanger inside Scenario 3. If silver gaps down while premiums widen and physical stays tight, the paper move is lying. Paper lies loudest when liquidity is thin. Now, the one-move illusion. People assume the first move is the only move. They forget markets often do a spike, then a pause, then a decision. That decision is usually made when the boring mechanisms arrive. Reroutes, surcharges, cancellations, policy statements, and back-channel diplomacy. So do this. Treat early claims as probabilities, not facts. Wait for the second source. Wait for confirmations. And before you act, ask yourself, am I reacting to information or am I reacting to tone? If it's tone, step back. Don't go anywhere because the next part is what most people never talk about. What happens after the reopen, when the first adrenaline wave fades and the market decides whether this was fear or a new floor? Here's a practical checklist for the reopen that keeps you out of trouble. First, watch the spread. If spreads are exploding, the market is telling you liquidity is thin. Thin liquidity makes stop losses slippery and market orders expensive. Second, watch the dollar reaction. If the dollar rips while risk assets dump, silver can get whipsawed even if the macro story favors metals. Silver doesn't care about your thesis in the first hour. It cares about flow. Third, watch oil's second hour, not its first headline. Oil often spikes on fear, then tells the truth when real participants decide whether supply risk is temporary or structural. Fourth, watch the premium gap between paper and physical. If spot jumps but premiums don't move, that's a paper move. If spot dips but premiums widen, that's stress. The physical market is slower, but it's harder to fake. Fifth, watch for the news vacuum. After a huge headline, there's often a quiet stretch where nothing new is confirmed. That's when price can mean revert violently. The market hates waiting. And one more thing, don't underestimate the psychology of Sunday night. People are tired. People are scared. People want to do something. That's exactly when mistakes happen. If you must act, act small. Scale, don't lunge. Let the market show its hand twice before you commit a full position. Because if you're wrong at the reopen, you don't just lose money. You lose clarity. And clarity is the asset you need most in volatility. Also keep an eye on the non-kinetic side of escalation, cyber and payment rails. When tensions rise, the risk isn't only physical, it's logistical and digital. Even a small disruption in banking systems, shipping software, or communications can create a confidence shock. And confidence shocks travel faster than cargo ships. If you see credible reports of sustained disruptions, that can change how long the risk premium stays embedded in metals. Now, quick answers to the questions that show up every time. Physical versus miners. Physical is an asset. Miners are businesses with costs and political risk. In a shock, miners can get dragged by the stock market even if metal is strong. Know what you're holding. Gold to silver ratio. It's a tool, not a prophecy. Decide your rules in advance and scale. The hardest part is swapping when silver is euphoric. Premiums and dealer pauses. Sometimes that's stress, sometimes that's risk management. Dealers pause when they can't hedge volatility. That's a spread problem, and spreads are the early warning light. Now, second comment question, and be honest. Do you think this conflict stays contained or spreads through the region? And what is your signal? Oil, shipping, diplomacy, something else? Here's what I'm watching into the reopen. 1. Is the early session thin and jumpy or heavy and sustained? 2. Does Asia confirm the move or contradict it? 3. Does oil hold the bid or spike and fade? 4. Do we get credible signs of shipping slowdown and insurance repricing, real mechanisms, not recycled clips? 5. Do physical premiums widen, stay flat, or compress? Because premiums tell you what paper sometimes hides. Now a final mindset shift, because this is where people get emotionally hijacked. You don't need the world to burn for metals to do well. Rooting for collapse is a trap. Because if systems break hard enough, you don't get infinite upside. You get rules. You get restrictions. You get allocation decisions. The better goal is resilience. Hold quality assets. Stay liquid enough to not be forced to sell, and let the long-term trends, debt, deficits, fragile supply chains, do the heavy lifting. And here's the closing hook you need to remember when the reopen prints. If we wake up to a huge move, the real question is not, how high did it go? The real question is, did it stay there once real liquidity arrived? That's how you separate a headline spike from a regime shift. So keep your head cold. If you're buying physical, understand premiums and delivery. If you're trading paper, understand thin liquidity and stops. If you're investing long-term, zoom out and breathe. And if you want more of these breakdowns when the next headline hits and the next open gets chaotic, subscribe. One click. Quick. Free. It keeps this work going. I'll be watching the reopen, watching Asia, watching oil, watching shipping, watching premiums, and watching whether the market confirms the fear or exposes it. Either way, you'll be ready.